Good afternoon, everyone, and welcome. Just gonna give 2 more seconds for everyone to come in. All right, let's get started. Good afternoon, everyone, and welcome. My name is Winston. I'm a dual degree student at Harvard studying public policy and urban planning. I'm also the chair of the Building Caucus at Harvard Kennedy School and the Infrastructure and Housing Club at the Harvard Graduate School of Design, which co-sponsored this event. I'm thrilled to have you all here today. This session originally began as a discussion intended for students across Harvard and MIT who are focused on housing, finance, and public policy. But as we started planning, it became very clear that these topics, the future of Fannie Mae and Freddie Mac, is not just timely, but also central to the structure of the American housing system. So we decided to open it up to the broader public, and I'm glad we did. We are incredibly fortunate to have two people who are deeply equipped to guide us through this. Don Layton, former CEO of Freddie Mac and senior fellow at New York University's Furman Center for Real Estate and Urban Policy. And Chris Herbert, managing director of the Harvard Joint Center for Housing Studies. We recognize that these topics can get technical fast, so we have asked our speakers to keep things grounded, skip the jargon, and focus on the bigger questions that matter to all of us. We'll be leaving time at the end for audience questions. If you have a question during the event, please submit it using the Q&A function of this webinar. We may not be able to get to every question, but we will do our very best to cover a range of perspective and topics. Now, to start things off, Chris will walk us through how we got here and what these institutions were originally set up to do. Then we will dive into a conversation with Don on what comes next. Chris, over to you.
Winston, thanks so much. I really want to tip my hat to Winston as the driving force behind this. As he said, he intended this to be an event for students, but once we put it together, and Don, who had been a fellow of the Joint Center, has such a big following, we thought we should open up to the world. But we do want to be mindful of our student audience. And so one of the things I want to do to kick us off, and at Don's urging, is to provide a brief overview of the history of the GSEs in a minute or two to kind of set the table. And then Don's conversation is going to be more, where do we go from here? So to set the table, the GSEs, part of the acronym, government-sponsored enterprises, of which Fannie Mae and Freddie Mac are two of the chief ones, are government chartered entities that are private. So the government issued a charter to establish these firms, but they have been for many years privately owned companies. They have the government's involvement is because they have a public mission. That mission is to provide liquidity, stability, and affordability to the housing market. And the charter defines what it is they can do and also what it is they can't do. In exchange for providing this public mission, what they get from the government are a number of favors, but the most important one is what has been known as an implicit guarantee. That is that having been chartered by the federal government, should they get into financial trouble, that the federal government would backstop them. This is not expressly in the charter. It was always assumed by the market, and as we'll talk about in a minute, in 2008, that implicit guarantee turned out to be, in fact, there. Just to specify what it is they can do, Fannie Mae and Freddie Mac are so-called secondary market organizations. That is, they're involved in mortgage lending, but they do not make loans themselves. They're not in the primary market. They purchase loans from other lenders. And doing that, for many years, their market share was fairly small. Up and through the 1980s, the two firms accounted for about 10% of mortgage lending in the country. They were there to backstop banks, who were the primary lenders, and to the extent that banks needed to have liquidity, they would sell their mortgages off to Fannie Mae and Freddie Mac, who would then sell them into the secondary market. But then, in around the late 1980s, when the savings and loan crisis hit, their market share grew substantially to about 45%, and they became much bigger players in the market. Over time, these private firms with this government backing found ways in which they could leverage that public backing to enhance their profits. And they became both very significant financial institutions and significant actors in the political system, lobbying for their benefits and getting folks in the industry to lobby on behalf of them as they brought cheaper capital to the mortgage market. This worked well enough until the early 2000s when, in conjunction with many other developments in the mortgage market that were expanding risk, Fannie and Freddie also began to expand their risk. There was a phrase that was often used, which was they were privatizing the gains, but making public the risks. And there was a couple of different ways in which they took on more risk. One was by purchasing securities of mortgage, subprime mortgage-backed securities that allowed them to get credit for making loans to lower income households. And they thought shielding the risk by buying only the highest tranches of those securities. But they also became very active in what was called an Alt-A market, that is alternative to A credit, where they were borrowers who had good credit, but otherwise were deficient in some ways of underwriting. And these loans turned out to be highly risky and were led to a financial crisis at the institutions in 2008 that ultimately led to the government having to step in and put them into conservatorship. In conservatorship, the way it was executed was through a preferred stock purchase agreement, PSPA. You may hear those letters thrown around, which had the government become the preferred stockholder, and in exchange for providing a line of credit to the entities to help them balance their books at a time when they were underwater. This amounted to about $191 billion that was extended to these entities, that all of which has been paid back. But the government continues to this day to be in the firms are in conservatorship. The government is their primary stockholder. And even though at the time, Secretary Paulson said that this would be a brief timeout, here we are many years later, and we're still in that timeout. So with that, having brought us up almost to today, I'll invite Don Layton to join me on screen here, and we'll begin chatting with Don about where we go from here. But first, Don, my first question to you is, did I miss any key parts of that history?
In accordance with Winston's directions to keep it relatively simple and jargon-free, you did a great job.
All right, I'll take that as a positive. And there's no omissions that were important that people should be aware of.
The only omission is one of the reasons Fannie and Freddie did fall into conservatorship is also they were very undercapitalized. They were known to be undercapitalized, but generally they and the industry interests liked that because it helped keep credit cheaper, but of course left them exposed in a downturn more than they should have been.
That's a really important point that I left out because that's one of the issues now is what's their capital requirements and is it adequate or is it in fact perhaps more than adequate? But let's get into it. So Don, as I said at the beginning, or at the end of my remarks there, Secretary Paulson said that this would be a brief timeout.
Right.
It hasn't been a brief timeout. Why has it taken so long? Why is conservatorship extended so much longer than expected?
Well, Secretary Paulson may have meant it to be a brief timeout, but he left office with the Bush administration, the W. Bush administration, about 3 months later. So the Obama administration came in. There's no single reason why it's lasted this long, but just a few piled up. The Obama administration, which came in, was unusual in that normally Democrats traditionally have been favorable to Fannie and Freddie, and Republicans not so much. But in this case, they were so in the doghouse politically and policy-wise after their collapse into conservatorship. The officially stated Obama administration policy with respect to Fannie and Freddie was that they were to be wound down, meaning at some point they would stop purchasing mortgages from the primary lenders and the old stuff would just mature and run off and they'd go to zero. And they were then to be replaced with, again, something else. Of course, then everyone went, all right, what's the something else? And they punted. They went, Congress created these things. Congress will come up to something else. And Congress tried, and there were lots of ideas thrown around, but the result was by 2015, nothing had made it, and people had kind of given up. And so there they were waiting for the never-ending something else. The second thing that happened, consistent with this wind-down policy, the rescue, and you mentioned the PSPA, this is an agreement in which they support the companies so they could keep operating the markets and people would buy the bonds of the GSEs and such. They changed it. And they did it in a way, still controversial to this day, that eliminated any possibility that they would recapitalize themselves through earnings, and in fact, forced a decapitalization over a bunch of years to near zero. Their net worth was going to be driven down to zero, consistent with a wind down concept. And so that was from 2012. So by the time the Obama folks left town, the GSEs had almost no capital. They did have the government support, so the market accepted them as a creditworthy entity. And then you were way behind in it. So that's the biggest reason. I'll come back to Trump later, Trump number one later, administration number one, where they did some steps to get them out of conservatorship, a few key ones. Then you have Biden came in, his administration never issued an official policy, but their unofficial policy, which they were happy to tell people, was they were not going to spend any time on conservatorship exit. And they kind of liked the companies being conservatorship because they could do things with them to suit their policies, their social policies, without a vote of Congress, because it was off the budget and was using GSE money. So that brings us to today, 16 plus years later.
I just want to go back to one point you made, which was that Democrats tended to be favorable inclined and Republicans not. And just for our folks in the audience, the general gist is, right, you have these big companies that are in the private sector. Republicans don't like the government messing around in the private market.
Right.
And so even though these are private companies, because they have this special favor from the government,
Right.
they view this as unnecessary meddling, whereas the Democrats felt like there was a good public purpose and this was a good public-private partnership. And that tension kind of still exists.
Yes, absolutely.
So one little detail, which I think is important in the story and thinking about where we go from here, is whatever happened to those original shareholders? Who are they're still private companies, right? Are those shareholders still around?
So the answer is the government might have loved to have taken them over fully and completely back in 2008, but for their own reasons related to budgets and debt ceilings, that's not the way they do it. They left the original shareholders in place. They still exist. The companies are still SEC registered because the stock still is there. It trades not on exchange, but what's called off exchange. The owners have moved heavily to professional investment firms doing speculative investments on a possibility of it being worth more money at some point. They're there. But the definition of conservatorship is that the conservator, which is the federal housing, which is their regulator, the regulator of the GSEs, takes on all the rights and powers of the stockholders. So the stockholders own these shares. They get no dividends. They get no votes on who the board is. They get no votes on stockholder resolutions. They're totally disenfranchised. They get to watch the government run the companies. And so they're there, but it's not clear what they own is worth anything. And that, of course, is up in the air at this point.
We may well get to this, but to the extent that they get released and reprivatized, to those ownership stakes, do they still have to be dealt with?
The answer is yes. The government left them in, so they have to be dealt with according to normal laws. And if they are reprivatized, those shareholders will get the rights back after the transaction. Just for the audience to know, how does the government get compensated for this rescue? They don't want the taxpayer to do the rescue, take all the risk. It's worked out well, but you never knew at the beginning. They had to put $191 billion in to cover losses. And it's worked well since then, but at that point, it was looking pretty grim. And so the government owns the companies overwhelmingly, but not 100%. They have warrants on 79.9% of the stock, which means the original stockholders got diluted 80%. And the money they've given in, and this is very complicated, we're not going to go into it, between what they put in and that controversial 2012 Obama thing about decapitalizing them, and what Trump, #1, did. They also have preferred shares, senior to everything else of ownership, worth about $330 billion in face value. So that's a big number.
It's a big
And
number.
it's controversial about what to do with that. So fundamentally, the government owns the economics of this company, but the shareholders are there for possibly a little bit at the end.
All right. There's a lot of complexity there, maybe more than our
Yes.
audience wanted, but some of those things are important to think about how to unwind them.
Right.
So I want to come back. So now 2008 in the fall, they go into conservatorship. It's 2025. You said 16 is going on 17 years. How have the companies fared being run by the government? The government's known, right, for being good at running organizations, right? How are they doing?
So the expectation, naturally, as a generalization, was the government, these companies would deteriorate under the government. Just a generality. Phase one of all this was 2008 when they were taken over to about 2012. This is when the companies in the mortgage system were in shell shock. All they did is face bad loans, more defaults, no systems to work on them, no history. The mortgage default's been so little in the past, it was just out of the blue. So the companies just kind of focused on that. But 2012 was a major year. #1, the defaults peaked and started to come down. And #2, the FHFA, as the conservator, said, Congress is not getting anything done. I got to look to the future with these companies, and issued what's called the first conservatorship scorecard. This was under the FHFA director at the time, a gentleman named Ed DeMarco. He liked baseball, so that's why it's called a scorecard. And it said, you're going to get better, and you're going to help improve the way the mortgage markets work by doing this, 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 and this. It wasn't corporate stuff like manage risk well. It was more, you're going to get together and align and update servicing functions and expectations by the servicers, the hundreds of servicers who handle all these mortgages. So it'll be updated and it'll be exactly the same, and the homeowner will know exactly how things are going to work. And at the same time, new managements came in to these companies, in my case being Freddie and someone for Fannie, and the boards had been largely updated, and they went, well, we're not going to spend our time lobbying anymore because that was taken away for the loopholes you mentioned. They figured out how to make money with these benefits away from the actual mortgage business. The best shot we have of the future being good for the organization and the people who worked at Freddie and Fannie was to start to be very good firms operating in the markets. And the reality is, prior to 2008, they weren't. They were great political firms to protect their subsidies, but they weren't so good operating firms. Remember, I come from the large financial institution world, what's now JP Morgan Chase, and they were nowhere near a well-run large FI as a generalization. So these companies started competing, investing in technology heavily, and they just pulled themselves up by the bootstraps. So about 2016 to 2017, the primary lending industry and the servicers all kind of looked up and went, wait a minute, what the hell just happened? They're operating better than they ever did beforehand. And that resurrected the reputation of the companies. So this is about when the Obama administration was leaving town. All of a sudden, instead of being in the doghouse, they kind of went, gee, they're kind of doing okay these days. The system is working pretty well. Let's not ruin it.
And Don, just to in full disclosure here, as you mentioned, you became on as CEO in 2012.
Right. Yes.
And so there's a little, not just Don Layton, but people outside of Don Layton would agree that this was a period of improvement.
Yeah. It's kind of universally accepted. A lot of people, and credit to the FHFA under mainly DeMarco and his successor, Mel Watt, they kept the politics as much as possible away from the GSEs and said, run good companies, and we will do the politics at the FHFA.
So your earlier comments made it clear that under Obama and then also under Biden, there really was no intention of releasing the companies.
Correct.
What about under Trump 1? Was there efforts to try to release the companies then?
Yeah, so let's level set on the issue. GSEs and GSE reform and privatization is a big issue in housing. But for the average American citizen going to the voting booth, this is like, it doesn't exist. It's inside baseball. It's complicated. It's not a highly emotional issue in any way for the average voter. So when Trump came in, I don't think Donald Trump mentioned the GSEs on the stump once. But his Secretary of the Treasury, who he picked, Steve Mnuchin, actually had an extensive mortgage securities background and stated right up front that it would be one of his top 10 priorities to try to get to GSE reform. And so everyone went, okay, so let's go. Unfortunately, he had his boss's priorities first. And so he was pulled off into things about terrorism financing and China trade deals and things. The Trump administration, number one, only got to the GSEs halfway through. So in early 2019, there was an executive order from Trump saying to Treasury and also HUD, let's not forget them, start working on some things. So Mnuchin and he had a very knowledgeable specialist working for him, produced something called the Housing Reform Plan, issued it in September of 2019. It's on Treasury's website. For anyone in this field, you should go read it. It's kind of long and got a convoluted document, but basically says, if we can get legislation, let's maybe go in this direction. But legislation wasn't very much expected, still isn't. So we actually can do a lot of GSE reform and get them out of conservatorship, but not have them go back to their old bad days by changing some regulations or changing some of the clauses in that PSPA contract. They need our support. That'll continue. Let's just add some restrictions there, which they had from the original deal. And they put that out. That's 2/3 the way through the Trump administration. Basically, what they were able to do was one big thing to move the ball down the court. They changed the decapitalization policy of the Obama administration and changed that deal so that profits were, instead of being given to the government, were retained by the companies. So starting near zero, the cumulative net worth of the two companies is now approaching $160 billion. So that was a good decision. But that's fundamentally the main big thing that was done. One thing.
But as you say, not unimportant, perhaps.
No, very, very important, but it's a reminder, and this is a theme you and I are going to talk about a little more. It's a big, complicated project to do. It takes time to accumulate capital. It takes time to change regulations. So good decisions early can be very important later on, that you're 2/3 the way down the court, not just starting again.
All right, so here we are, beginning of Trump 2. And once again, we're seeing headlines about exit.
Yes.
And so I guess the big question is how likely is exit in the next year or two or three? And I guess in part of that is, you've already referenced this, but is there is it necessary for Congress to act, or can we do this through some administrative means?
Okay, so let's start with how likely it is. Rule number one, after spending 7 years in Washington, never say never. You never know what's going to happen. So I'm going to talk about what the evidence leads you to believe is the most likely outcome, as opposed to predicting what I want to happen or hoping or something. I'm just going to focus on that. It is highly unlikely conservatorship exit would happen in the next year or two. You could have a step or two taken, like they did in the first Trump administration. That would be helpful. But number one, the media is talking about this, and the pundits are talking about this. If you look carefully what the actual Trump administration people have said, they have made no commitment to undertaking it now. They have made no commitment that it would be quick if they did. In fact, they've said the opposite. We'll be very careful and it will take time. That's because no one wants to screw up the mortgage system, and all of a sudden mortgages, which are now what, 6.7, 6.8%, they don't want to show you screw it up and all of a sudden it's 9. No one wants to see that. So they're cautious. So all the talk is you should understand it as advocacy by people who would like the Trump administration to put it on the front burner. And there's a few groups like that. And it's just the magic, the media, everyone loves talking about it. It's a hot topic. Someone told me once, gossip makes Washington go around. So lots and lots of talk, not much from the administration that they're actually going to do it starting soon. So on that basis, I go, maybe they'll do some planning, maybe they'll do some things, but I think the likelihood is more akin to Trump number one, i.e. they'll get to something later, not right now. To the average citizen, tariffs and taxes is a much bigger issue. Quick anecdote, Scott Bessent, Secretary of Treasury designee at the time, went to his confirmation hearing. In the actual hearing, not one single question about the GSEs. It's a reminder, it's an inside baseball issue. It's always important, but it's never urgent.
Don, we didn't talk about this, but it might be helpful to clarify. So you've already referenced that. So under Trump 1, there was this notion of amending the PSPA as a way
Yes.
to kind of facilitate exit. And so
Yes.
it just in no small part, what that does is it keeps a government guarantee in place to help the investors have confidence that that's there.
Right.
The other alternative would be to release them as just purely private companies without any kind of government backstop. And then the third one would be legislative action to kind of reconfigure them. I think we can probably dispense with the legislative action, as what one can't even possibly foresee that happening anytime in the next X years. So it's kind of, that's not really on the table. So between release with modified PSPA versus release free from the PSPA, how would you characterize the likelihood of those?
Okay, so the GSEs are subject to controversy. So the comments come from people on the extreme right all the way through the extreme left in their views. The broad mass likes the system as it is now, not everybody. So number one, when the concept of GSE reform without congressional legislation was developed, this was back around 2016, 2017, inside conservatorship, the concept was government support would continue, with the PSPA would continue. That's because the mortgage-backed security investor likes having that. They from the very first day, decades ago, that you did securitization, they were promised that this was a government near Treasury credit quality piece of paper, but they're accepting all this crazy interest rate risk associated with prepayments and things. And that's who they are. And it was, if you took that away, those investors would be largely uninterested. You'd have to find different kinds of investors, and rates would go up, and it's not clear that there are those investors for a combined interest rate risk and credit risk instrument for currently outstanding $6 trillion worth, large numbers. So it was always assumed to continue. In the Trump #1 housing reform plan issued in September 2019, it said, if Congress would legislate, here's some things, and if they won't, here's some other things, and included in that was the PSPA would be continued and would be amended. So the closest thing you have to a precedent is that. So the third is that back in 2014, in the House Financial Services Committee, then under the control of Republicans, proposed, because the head of the committee was very libertarian, a something else system with no government support. It could not even get a majority vote in the Republican caucus in the House, so it would go to the floor of the House. They were a majority, it wouldn't even get, because people didn't believe the market wouldn't be much more expensive and less available credit. So that's what you have. Some people still like it ideologically, but I think the strong mainstream is it stays. The government support stays.
Okay. So maybe you already asked this, but answer this, but so you described the handicap, but so let's say, what's your expected likelihood for when an exit would take place? It's not the next year or two, is it?
If you do, again, never say never, a fully responsible exit where you do all the homework and take care of everything as opposed to let's exit, see what breaks, and then we'll fix it. But doing it more the traditional way of doing your homework first and making the regulation changes needed, making the PSPA changes, and figuring out how you're going to get all the capital they need, which is an extremely large amount of money. I just want to give a quick reference. The largest stock sale ever done in the world's history, which was Saudi Aramco, was a little less than $30 billion. Currently today, the shortfall in capital between the official capital system, which I actually think is too high, but it's the official one, and where they are today is $200 billion.
Okay, so
This
that's
is,
like
yeah,
6-7 times.
yeah, this is, and these companies, it's not, they're these weird hybrids, government, it's not clear how they're going to look after conservatorship. So it's not going to be an easy stock sale. And I say that from someone who used to do those kind of things from time to time. So the notion that you can just snap your fingers and raise all this money, that means it takes time. So my center point is that Trump 2 can take some good steps to move the ball down the court a bunch, and that's as far as they'll get during the 4 years.
Okay, so let's fast forward then, let's say, I don't know, 4, 6, 8 years from now, right? At the current rate of profits, they'll actually be pretty well capitalized in about 5 or 6 years.
If you do the math, it takes 10 years.
10 years.
10 years.
Okay.
However, as I said, the current capital requirement official is, I consider, and many people consider, unduly high, punitively high. And no one wants to go back to the old undercapitalized days. But if you took more of a, well, everyone has their view, but I would call a less biased view, kind of a main view, then it's only maybe 4 years or so. That becomes a little more contemplatable.
Okay, so here's the scenario then. 4 years from now, roughly, between a combination of continued profitability and revisiting the capital rule, they're whatever position they need to be in to be, if they need to raise some private capital, it's not Saudi Aramco.
Right.
And so and the other thing to remember is there's two companies, right? This is just one company.
Yes.
This is two companies.
Yeah, I'm
So,
doing all the numbers for the two of them together, but at some point you have to figure out how to handle two.
like, are they happening the same day? How's this happening? But that's another matter for another podcast.
Yes.
So so your version is that when this happens, it'll happen with some version of a modified PSPA.
Yes.
All right. So let's take that scenario. 4 or 5 years from now, we're in the situation.
Right.
They're able to get released. So what happens to the mortgage market? So first of all, let's think about this. Like, is the cost of mortgages going to go up? Now the big brother's not standing right there?
Yeah. No, Big Brother, well, Big Brother will still be standing there, but just through the PSPA. Okay. So yeah, that's the title of this session. So let's get into it in some detail. Will mortgage interest rates go up? So how are mortgage interest rates determined? Back in the 60s and 70s and into the 80s, the government tried to control mortgage rates, and it did not go well during the S&L era when they collapsed. Since then, the mortgage rate is largely, not 100%, but largely 70% of the market is done by the GSEs or other government agencies. It is driven by primarily the market. They issue mortgage-backed securities. They package this a pool of mortgages, sell them. It's the rate is what the rate is to get investors to take it. Of course, Fannie and Freddie guarantee the credit to those investors and are backstopped by the government in doing that. So let's take today's mortgage rates. It's about 6.7, 6.8 now. Of that amount, 90% of it is the mortgage-backed securities rate. So what will rates be? It'll be based on what the rate in the market is. 90% of it, roughly, is whatever the market is. And that trades off of 10-year Treasury rates. So that's inflation and monetary policy, plus whatever the recent history is to drive the extra charge for taking all that option-style risk on prepayments being faster or slower. On top of that, then you add the GSE charges what's called a guarantee fee, known as the G fee. That's its revenue source, to guarantee the investors and cover its own expenses, and then says to a primary market lender, here you go, it's the mortgage rate from the market, our guarantee fee. The average guarantee fee lately is running 55 basis points, less than 1/10 of the entire mortgage rate. So when everyone argues about the guarantee fee, remember, we're talking about not much. And then the primary lender adds their markup and fees, which can vary quite a bit cyclically based on competition and such. So will mortgage rates be higher or lower? Depends on where inflation and Fed policy is overwhelmingly. Second, how much can the GSEs impact it? The answer is, if they mess it up, maybe rates could go up 5, 10, 15 basis points, 20, but that's a lot. I do want to note, this is a little one of these complexity, the government has kind of discovered the GSEs as being a little bit of a captive cash cow to them now. So over time, they have added taxes and charges, some overt and some covert, that are buried in the guarantee fee. And so actually a whole bunch of that money moves back to the government. So it's already higher than it needs to be. But these are small amounts. Most people are not going to make big changes in decisions whether the mortgage rate is 6.7% or 6.8%. So the answer is, I think the risk is the G fee might be a little higher, but not much.
Okay. And and I don't want to open a can of worms, but we're taking as a predicate the PSPA in place. And if we said, in fact, they were released without that government guarantee, your answer would be quite different.
Yes, then it's not the G fee, it's that the mortgage-backed security rate, well, no one knows. This is one of these, you can't do controlled experiments in the real world here. How much would that rate go up? I'd say the broad consensus is a whole bunch, but some people go, don't worry about it, the market will adjust. I'm not such a fan of that myself.
What about, there's questions about, so the US has unusually, right, has a 30-year fixed rate mortgage, and that it's attributable to the fact that with the GSEs and that government guarantee gives investors the confidence that they don't have to worry about credit risk. So in this circumstance, do we have to worry about after the release whether the 30-year mortgage will continue?
So in the world, it's known as the American mortgage. It is unique in the world. The final payment maturity is 30 years. That's not so uncommon. What is uncommon is the rate is fixed for all 30 years. Number two, you can prepay it for no penalty, zero, at any time for any reason. That's hard to do. That's hard to figure out how to do.
As an investor, right? Because suddenly you're getting your money back at the least opportune time.
Correct. Well, think of who's the lender. If they're going to make a loan, think of the old bank-style mortgage lending. If I'm going to give you that right, what funding do I get that I can prepay? And the answer is doesn't exist.
Right.
So that was the problem with the S&L crisis. So this is extremely borrower-friendly, and there are other bells and whistles on it, including the ability to have borrow pretty easily 90 to 95 and even 96%, 97% of the purchase price in a loan, as opposed to the old 80% days. Those are long gone. The average borrower is borrowing more like 90%, and you can go higher. So this is very favorable. And I would say it is a consensus, never agreed by everybody, that the GSEs are core to that kind of mortgage being available to the broad, middle, and working class. Because if they don't provide it through this complex mechanism with the mortgage-backed securities issuance, who's going to provide it? Banks cannot do it past a modest point because they can't handle 30-year free prepayment assets because they don't have those kind of liabilities. Banks only provide about 25% of mortgages these days. So they're considered core to that. And people are afraid if they go away, so does that for the average American. Not wealthier Americans, but average American families.
Don, I want to be mindful of time because we do want to leave some
Yeah.
time for folks to answer questions. Let me quickly, would you expect to see any changes in credit requirements after exit?
Interestingly, the fear, of course, is they would be tighter on any credit requirements, but it's unclear to me why after exit, as competitive stockholder-owned companies, they would be interested in being tighter. I'd say the concern might be they would get too frisky and be too loose, and that's why you have a regulator. I do want to mention one of the weaknesses in the old days was the regulator was Congress designed the predecessor to the FHFA to be a weak regulator. And we can get into why that's sort of peripheral. And in 2008, when they got rid of it and replaced it with the FHFA, they designed it to be a strong regulator. That is a key difference between the old world and the new. So I would expect the FHFA to be able to do its job and make sure the GSEs don't get too frisky on credit.
And I guess related to that, so, the story we tell is the ways in which we had privatized profit, but public risk prior to 2008. If we go back, we release them into the wild again. Are we going to get back in that situation where we have that mismatch between who's bearing the risk and who's getting the profits?
The nature of these hybrids called GSEs, not just Fannie and Freddie, but the other ones, mostly which is the home loan bank system, it's always that tension. And if Fannie and Freddie are released, and it doesn't happen right away, but over decades, they will start searching for ways to make a profit through loopholes. The point is, we've seen that act, and the whole point about GSE reform is to amend the PSPA and regulations to close those loopholes because we know what they are because they did it once. And that's why you need the investment portfolio limit. By the way, their investment portfolios are down about 85% since they were at their peak way back when. Total used to be over $1.5 trillion. Now it's under 100 billion each.
And just to clarify for
Yeah.
folks, and so this was kind of, I'm trying to find the right description, but it's basically because we have this government guaranteed access to cheap capital. What the GSEs could do is like, let's go out. We're gonna have this big portfolio that's paying us a higher income than our cost of capital, and kind of leverage that and build up these big, massive balance sheets that are just based.
It was an abuse of the implied guarantee. They borrowed near treasury rates, cheaper than anybody else. They bought mortgage securities and they got a spread, but the spread was all due to the cheapness of the funding.
And before that, there was a time when they actually were investing in things like tobacco stocks and they actually had a big mutual fund they were running.
Yeah. So that loophole has been taken care of. You hope over many years their lobbying wouldn't reopen loopholes, but you'd always have that risk. That's the nature of this combined hybrid of a government agency and a private corporation.
All right. Let me, there's actually, I'm getting some word of some questions that have come in that are kind of relevant here, which is one of the questions is, okay, so we're talking about exit. Why are we talking about exit? Is something broken that needs to be fixed by exit? What are the best reasons for exit as opposed to, gee, if they're working now and the government is able to kind of steer them the way they want, what's wrong with that?
This is exactly the question and exactly the answer that you got during the Biden administration. What's wrong with conservatorship right now? The mortgage system is operating excellently. Yeah, maybe the GSEs would be a bit more innovative, and maybe over time it's getting more political. You worry it'll get worse. But by and large, most people go, if it ain't broke, don't fix it. But that runs into the legal notion of conservatorship. It's not meant to be a government expropriation of the company. By legislation, they're supposed to be returned to their stockholder control. So it's sort of a good government and adhere to the spirit of the conservatorship laws that you should be working to recapitalize them and return them. If you didn't want to do that, you shouldn't have put them in conservatorship in the first place. So it's that contending with the practical risk that it's working fine now. And there is a consensus conservatorship exit has more downside risk of messing things up than upside risk. The upside risk is just keep things going well now. So hence when people do their political analysis in the various administrations of where to put their time, they go, this is not a high priority. Yeah, it's important, but not now. I got something else to do now.
We're actually getting some questions too, Don, that I think what you had anticipated, which is that there's been talk about a sovereign wealth fund.
Right.
And can you explain to us what's that about and how the GSEs relate to this sovereign wealth fund?
Well, you can't say much about a sovereign wealth fund for the US because you're not exactly sure what is meant. So let's just a little 2 seconds on sovereign wealth funds. These are created by countries that have big, I'll call them trade surpluses or budget surpluses. And it's what do we do with the money? And they have their own reasons why they maintain a sovereign wealth fund that usually invests not in their home currency and such, Norway or Saudi Arabia. So when President Trump goes, I'd like a sovereign wealth fund, and his people go, yes, ma'am, sir, let's see what we can do. We cannot do what the others do. The name may be the same, but it doesn't represent the same situation. And he has tasked the administration officials with coming up with one. So the problem is, if they don't have these surpluses, we have deficits, where do we come up with something other than taxpayers just putting money in? And including Secretary Bessent made a very small comment, well, maybe the Treasury's ownership of the senior preferred, I mentioned the 330 billion and the near 80% of the shares of the GSEs could be an asset you could move over. That's as much as we know. We don't know what the sovereign wealth fund, how it would be constituted, what its purpose would be, whether the idea would be to hold these shares or whether to sell them off, which would take a long time because the amounts are so high. It's all a blank slate. Everyone is putting their own ideas on and gossiping. But the answer is we don't know what it means. And I have to ask the question, what's the difference between the sovereign wealth fund owning these shares versus Treasury owning these shares? Strikes me it's sort of the same people with a different name on it until I hear otherwise. So the answer at this point, I think you should just go, interesting thought. When we learn more from the administration of what they mean, then we'll be able to make some intelligent comments.
I hesitate to ask this question because I don't know enough to make sure it's an intelligent question, but my understanding was there was some sort of accounting aspect of this which had to do with the sovereign wealth fund would be on the balance sheet and could be taken as a credit to count against any kind of tax cuts. So we take these, big valuable assets and put them into the sovereign wealth fund. Somehow that's a plus for the administration and other things they want to do.
Yeah, well, I've also heard, and I am not a federal budget accounting expert, that the belief that these assets are on the books of Treasury at zero is incorrect, that the government accountants have been fair valuing these positions over time and have actually considered them revenue to the government over the last bunch of years. And I've heard various numbers between 100 and $200 billion, in which case there is no free lunch of moving it over and having anything, because then you have more of a deficit. So the answer is, I just regard it as a very confusing technical area. And when we hear more definitively, we'll hear more.
Okay. This may be kind of related to the conversation we just had, but about why exit. One of the questions that came in was, why not just treat the GSEs like a utility, something that's too important not to be regulated? And maybe you could, like, there's a lot of talk about the utility model. Can you say a bit about what that means in the GSE context, and whether you think that's an option?
Yeah. First of all, the GSEs will be highly regulated as large financial institutions by the FHFA to start with. So
No
this
matter
is not
what.
like a state level public service commission regulating an electric utility, which otherwise would have no regulations. So they're already regulated highly. The utility model is referenced to where the GSE, their guarantee fees would be set by the FHFA like a public service commission sets the rate schedule for your electric power. Specifically that aspect. Otherwise, they're regulated highly anyhow. As opposed to the guarantee fees being set by competition, both between Fannie and Freddie and them against the other half of the market. Remember, they're currently about 50% of the market, actually lately a little less, versus the others. And that's what people mean by the utility model. It's a relatively narrow topic. It's important, but it's not going to drive whether they exit or not. It's really designed to make sure that they don't implicitly collude to keep G fees high. But that ignores the rest of the market, because they will lose share to bank balance sheets or the other government agencies like the FHA, Federal Housing Administration, who actually most recently cut their rates.
We're also getting some questions about other things. We're talking about exit a lot, but so we now have a new sheriff in town. Director Pulte is running FHFA. Yep. What other, aside from exit, what other changes should we expect to see in the GSE operations in the time now between now and the end of Trump 2?
Very hard to predict. As we know, the Trump administration is doing lots of very strong actions on lots of things, but they have never said what their strong actions might be about the GSEs. Again, it's a very insider topic. Director Pulte has come in. How long has he been there? 6 weeks or something like that? He has adopted the Trump White House style. He took a lot of very strong, flamboyant, I think is the right word, actions, attracted a lot of attention, replacing or getting rid of and replacing board members, changing office hours to be 5 days a week, meaning in office hours, getting rid of anything that looked like DEI stuff. In other words, the Trump administration priorities. But virtually none of this is related to the core mortgage markets. And so we await to see what it might mean. Now, what's interesting here is you might go, well, I could predict what the Trump will want given what who their supporters are. And the answer is you can't, because 3 of their core supporter groups have very different ideas about housing and mortgages. One, you have influential, what I call small government conservatives, think tanks in Washington who have been very influential in the Republican Party for years. They want to shrink the footprint, shrink Fannie and Freddie, smaller, as you mentioned. They don't like this mixing of government and private sector, shrink it. If you can't get rid of it, shrink it. At the same time, you have the core voting group of, what do they usually call it? The non-college educated households is the Trump voting base. They want cheap, easy mortgage credit. Their advocates don't want to see that be made higher. Trump himself has said, whatever you do, don't raise mortgage rates. He's reflecting that group. And then you have what is presumed to be the normal Republican bias towards business operations. But the mortgage industry, meaning everyone on it, the home builders, the realtors, the mortgage bankers, all of these, they like government subsidies to mortgages because they make more money as a result of that. So it's not clear what group is going to be dominant in this hassle. So it's very hard to figure out what Pulte's marching orders. He is not an independent regulator. He works for the administration since a key Supreme Court decision took away their independence back in 2020. And we shall see where they go. But literally, there's been almost no indication so far.
What about the mission-related work? So we have affordable housing goals, we got duty to serve, we have the National Housing Trust Fund. There's the Equitable Housing Finance Plan started under Biden. What do we expect to see in those domains?
Okay, let's divide those up. There are two, what I'll call social welfare programs passed by legislation that apply to the GSEs. One is known as the Affordable Housing Goals, goes back to the 90s. And the other is called Duty to Serve, which is a bunch of things like manufactured housing or renovations and things that was passed, I think, in 2008. Those are by legislation. So the GSEs will be.
National Housing Trust Fund is part of that too, passed by legislation?
Well, let me get to that.
Okay.
This is things where the GSEs have to do things. And the FHFA, as the regulator, was given a lot of authority by that legislation to translate general congressional goals to specific actions required of the GSEs. So the FHFA, now under Director Pulte, could be more or less aggressive and still adhere to that legislation. And we don't know yet because there's been no evidence of what's happened. That's number one. Number two, I mentioned the Congress has discovered the GSEs as a way to kind of do indirect taxes. They are obligated to make payments to two other housing-related operations, one in Treasury, that's the Capital Magnet Fund, and one in HUD, that's the Housing Trust Fund. That's by legislation, and that's mostly by legislation, and that's a formula. The GSEs don't do anything different. They just write checks. Profits have been so good lately. The amounts of checks they're writing are high. The guarantee fee, this is the numbers I remember, 20 basis points of the 55 basis points is their operating expenses. Half of that, 20 basis points, 10, is the checks to those two funds. So it's a large percentage of their expenses because their profits are so high. And that is primary. Now, the other thing then, during the Biden administration, based upon the FHFA as conservator, no legislation, no background legislation, put in some additional social welfare programs, I'll call them generally. One was what you call the Equitable Housing Finance Plan. That one particularly had DEI aspects that has already been canceled. Sorry, that was a label over many programs. The ones that were DEI related were canceled. It's unclear about the non-DEI things that were in there. But those have no legislative background. That was strictly arbitrary by the FHFA, reflecting the Biden administration priorities.
All right, so now we're at time. I guess one thing I just to kind of loop in some of the other questions. And so some of the questions too were like, well, what about these things after release? And so it sounds like, you know, to the duty to serve, the housing goals, the trust funds, they're built into legislation. So if exit happens without a change in legislations, those are still in place.
Yes.
With subject to the caveat that FHFA still has a fair amount of leeway
Correct.
in terms of how strictly they enforce and regulate those things.
Yes.
Well, unfortunately, we're at time.
Right.
I think we covered a lot of the ground we hoped to. Don, as always, appreciate your insights on this. You bring a tremendous amount of experience, but also a great gift at being able to break it down and explain it in a way that I find pretty accessible. So we're going to have you back. It's been too long since we had you on the
okay.
But thanks so much. Appreciate it.
Okay. Thank you. Yeah, it's I've started to call myself like they used to have these people called Kremlinologists. I'm a GSE-ologist.
Sure, I like that parallel. You know, whenever we think about the GSEs, I don't think they're the Kremlin.
You know, I can tell you if so-and-so is standing next to so-and-so, it means something. But it's a great field. It's so important to America, and it is unduly complicated, and it's very hard for people to penetrate. So that's what I take as my objective of my writings and speaking, to really not push an opinion so much as to explain so people understand what's really going on.
Well, as we can all are well aware, the world is a fluid place these days, and should things evolve and change in ways that would be helpful to get you back, we will do that. But
Okay.
Don, thank you so much. I
All
want to
right.
give a shout out again to Winston for
Yes.
organizing this. Thank God for the students at Harvard to make these things happen, and to David and James and Kerry and other folks at the Joint Center. So thank you all. Winston,
I
did
agree.
you want to say anything else as a blessing?
No, I just wanted to say thank you all for joining, and thank you, Chris and Don, for your participation, and hope everyone gets something out of this, and I'm sure everyone did. Thank you.
Okay. Thank you, everyone.
Thanks, everybody.